Okay, Mega team, welcome back to the channel, guys. Thanks for tuning into today's video. We have a big video today. It's going to be a long video. We have so much to talk about. Obviously, you've got the CPI coming out later today. We have to be prepared. We have to know what's going on. We've got to talk about what we can expect and what will happen when those numbers come out. We've got so much to talk about today. Doing the analysis, doing the charts, looking at the short term, the macro, absolutely everything. Now, before we get started, if you like the content, smash that like button. It helps actually promote the video, pushes the video to more viewers, and gets the channel growing a bit. So I really appreciate that. And of course, if you want to join our Telegram channel, first link down below. You get all of our videos in here, all of our charts, updates, analysis, and so much more. And of course, if you do want to join our VIP, you can see all of our VIP results every single month over here. If you just scroll backwards through here, you'll be able to see September, August, all the way back to February 2021. You can go ahead and contact me via here to join. Let's go ahead and get into today's video. So we'll start with an analysis and then we'll go ahead and talk about the CPI. So let's go ahead on the large time frame. We've talked about the 12th to the 21st of October many times already. And this is a very important period of time for Bitcoin, as this is a time frame where our horizontal lines, the date range, meets up with the junction point of our 19,000 support and a downward trending resistance, as well as the 21st being that junction point of the absolute bottom, which is 17,600, and that downward sloping resistance. So we have this small little date range here where we do expect a big move to occur. A volatile period, something's going to happen. We should make a directional move before the end of the 21st, and it should tell us where we're going. Now, it's not guaranteed, but it is very likely that we go through this phase here, and by the end of it, we've cleared to the top side or we've cleared to the downside, confirming the fact we're going lower. So it's very important we took a look at that. We're going to come back to this chart later on when we do a macro analysis, but let's go ahead and just zoom out a little bit. What we can see is we can see two trend lines. I'm going to go ahead and delete this one. We have our first one, which is our downward sloping diagonal resistance. Now, to break above this resistance doesn't really mean we're in a bear market, doesn't mean we're in a bull market. It actually doesn't even mean we've broken out of the bear market. What it does tell us though, it tells us that if we do break above this resistance, we have another chance at actually pushing upward towards the major resistance zone, which is this zone over here. This is probably the biggest resistance on the chart right now that we do need to face and clear. This is at 22,000 to 24,000-ish range. Now, the 22,000 to 24,000 range, as you can see, has provided a lot of resistance way back in December 2020. Now, this was like that last final resistance point before we went into this huge rally up for Bitcoin in January or February, and everything started pumping up. So we've got to retest that at some point. We've got to break through that at some point if we want to see any inkling of upward price action on a larger time frame. So breaking that downward descending diagonal will send us up there. Now, that is important because for us to break out of the bear market, we need to break through this second trend line. This is our downward sloping. This is a diagonal level, but this makes up the upper part of that downward sloping support line. So it brings us into a descending channel. Now, this lines up with around this $30,000, $28,000 range currently, but it should push in between those two levels by the time we actually even test that point if we do push upwards. So this will provide another point of rejection on the chart. If we are able to push through this level here, push through this level here, and get into this range, that is when the bear market is officially actually over. Until then, we're very much still in the bear market. We can very much continue downwards, and we'll come back to this chart later on in today's video and do more of a technical analysis with more or less just identifying some of these zones. So every single gray box you see here is a major rejection point. The green lines, obviously, there's a major rejection points as well, and the red lines down below are huge support zones. So let's go ahead to our smaller time frame, and we'll come back to that later on and do a technical analysis. But on the shorter time frame, and we've talked about this a lot already, if we go ahead and just ignore everything on the chart except these red and green lines, so it's hard to see. If you ignore everything except the red and green lines, we do see we have this horizontal range actually playing out on the price action right now. And this horizontal range is a neutral pattern. We've had, what, 3 breakout attempts to the upside. We had 2 breakout attempts to the downside. Okay, the first one doesn't really count. So 1 proper breakout down attempt, all of which didn't really go anywhere. On the 2 breakout attempts to the top side, we got rejected in that major resistance zone. And this resistance zone, you can see the upper basis point of that is 20,400. It acted as a resistance numerous times before. The lower part of that was a resistance point on the candle close from the previous breakout, as well as the entry price or opening price after that initial breakdown from the top of the channel. And we actually retested that a lot. So this is the major zone. Now for us to break upwards from here, it will be pretty bullish. As you can see on the chart, it's acted as a massive area of support or resistance prior to this. It would be quite bullish for us to break upwards. But as I've been saying, until we break upwards from there, it is looking more grim than it's looking bullish, because we are still in this rising channel. And this obviously rising channel is a bearish structure. And we did a break to the downside of that channel. We saw a push downwards. We found support. We found some temporary support along this new uptrending support line, this dashed line, as you can see. Didn't really push upwards too much. We got a small long on the charts right now, hoping for a push upwards, as we do have a very short time frame descending channel forming over here, which is a bullish structure. And of course, for us to see any significant upward price action, we would need a break out of this downward sloping resistance and get back above this green line. Obviously, these triggers still remain. So going back to these triggers, for those of you who are new to the channel, red lines are major triggers, green lines are minor triggers. If we do break any of these red lines, we expect massive continuations in that price direction. As we have seen, we break the red line, we go upwards pretty big, upwards pretty big, again upwards pretty big, and we break down, we go down again, quite large downwards, quite large downwards. It's very explosive moves occurring. Now we do expect that to happen to a greater extent on these upper and lower red lines, meaning if the price falls below this red line here, 18,400, we expect the price to come on down to the absolute bottom. If the price breaks above this upper red line here, we expect the price to push upwards. That upwards push should take us to that $22,500, $24,000 range. So we are in a tight range over here. A lot is resting on the decision of the directional break out of this horizontal range. This is a really important range right now. This is really going to tell us what the next few weeks of price action is going to happen for Bitcoin. Now on the 3-hour chart, it's not looking too great. We obviously have a very bearish candle over here forming, or just formed, sorry, but we'll have to see how the price goes. And we'll talk more about this one later in today's video when we get to the CPI and when we do our technical analysis. But just to give you some identification, these horizontal levels are zones of support, meaning we do expect support at these levels, we do expect resistance at these levels, and we're very much just playing this range. It's a very long range, a very boring range, a very choppy range in fact, and I guess at the moment it's more or less we're still in the range. We still have to abide by the same rules of the range and just trade with the supports, trade with the price action, and don't think too large time frame right now while we're in this range, as the big directional moves will occur when they trigger these levels. Okay, Bitcoin dominance, more or less looking the same, hasn't really moved. We talked about it many times. In a massive horizontal resistance range. Break upwards here, we're very bullish. Break downwards, very bearish. Brave new coin Liquid will come back to. DXY will come back to. Total cryptocurrency market cap, of course, the only bearish chart I see right now. Only chart I'm really worried about this is a descending triangle, of course. Descending triangles can take us much lower. And this is a big descending triangle in a very critical point. As you can see, this descending triangle over here has a measured move target of around 400 billion. This will take Bitcoin to about 12 to 13,000. I've been talking about this a lot already. If we do break below this level here, this will occur, this break will occur before Bitcoin breaks the absolute bottom of 17,600. So if we see the total cryptocurrency market cap break below, that could be a leading indicator for the fact that Bitcoin will continue downwards. So this is why we're keeping an eye on this chart, because it's acting as a lead on the market right now. So it's very interesting to keep an eye on and make sure you're watching these levels. Obviously it can revert. Of course, Bitcoin total cryptocurrency market cap is not bound by the same units of TA as we hold standard to the rest of the market, but at the same time it does more or less follow standardized TA due to the fact that the majority of this is made up by Bitcoin, and of course Bitcoin follows TA, altcoins follows TA, so naturally it's going to follow TA to some degree in terms of structures, in terms of zones, in terms of horizontals, but it's not going to be as precise. Okay, so let's go ahead and talk about CPI. We'll talk about CPI Then we'll come back and do our technical analysis on the charts, bring up all our indicators and stuff like that. Now, before we get into it, guys, if you do want to support the channel, go ahead and sign up to Bitget down below. The link in the description, you get access to everything over there. You can find out more about it at the end of the video. Probably the best place to be trading, particularly if you're doing leverage trading. That is where you want to be. That is where I personally trade. I've been trading there for about a year now, and honestly, I will probably never ever leave Bitget. Fully decentralized, lowest fees in the game. Honestly, it is probably one of the best exchanges. Anyway, more about that later. Let's go ahead and talk about CPI. So there's a few things coming out CPI later today. We obviously have core CPI and we have year-on-year CPI. And we'll talk about the differences in those later. But we had the PPI, which is the producer price index, actually come out yesterday. And usually I don't really talk about the PPI as it's not as important as the CPI, but we're going to talk a little bit about today and kind of explain what it is. So essentially the PPI, as you can see on the chart, as you can see over here, it measures the change in the price of goods sold by manufacturers. Now, this can be a leading indicator for CPI because if manufacturers and producers increase prices, if manufacturers and producers incur higher fees on production, they're more likely to push those fees onto consumers, meaning that the prices for consumers will rise and therefore inflation rates will probably rise. So it can be used as a leading indicator for rising inflation, but it's not always the case. There is a correlation, but it's not an exact perfect correlation. It is just a weaker correlation there. So something to keep in mind in leading into CPI now that we've seen PPI increase, could potentially CPI increase is something to keep in mind on. So obviously PPI came in 0.2 higher than forecasted, which is obviously a rise in PPI, which is obviously a bearish thing. It's not a very good thing. We saw the market slightly react negatively. If you can see on the Bitcoin chart over here, we saw these long wicks down. And I think it was this candle over here particularly. We saw the news release, we saw about a 1% dump on Bitcoin. We saw the DXY pump a little bit, but again, not as big as a move as you expect. CPI is much more relevant. It's going to have a bigger effect on the market in terms of the strength of the dollar. So that is something to keep in mind. And obviously we have consumer price index year on year, so CPI year on year. And this measures a change in the price of goods and services from the perspective of the consumer. So absolutely it takes into account everything. So what we're looking at here is a forecast of 8.1, previous of 8.3%. Now, we're going to talk about this in quite some detail again, and I have to kind of explain it in chunks. For the new viewers, if you want to get a full understanding of it, we have to explain it in chunks. So first and foremost, I'll explain what we expected a price action. Then we'll go talk about how it actually works, how the data works, and why it impacts price, and then we'll come back and talk about our plan. So first and foremost, previous was 8.3, forecast 8.1. If we see the CPI come in at forecasted or higher, we will see a bearish reaction in the market. A bearish reaction in the market for short term, and we should see prices dump. We'll see the DXY rise. If we see the actual come in lower than forecasted, it will be very bullish. We'll see the US dollar tank. We'll see asset prices jump, okay? Same with core CPI. So core CPI, the only difference between core CPI and CPI is it excludes food and energy, okay? Measures everything, excludes food and energy. So what we're seeing here, we're seeing forecast of 6.5, previous 6.3, exactly the same method. If we see the CPI come in at forecasted or above, negative reaction in the asset prices market, okay? Dollar will pump. If we see it coming below, dollar should drop, asset prices should pump. Now, although I'm saying this will happen, there's a chance it won't. We could see a completely alternative scenario play out. But I'm going to explain why this is the case in theory in a second and give you the data to support it. But generally, when it comes in at or above, we see US dollar strengthen, go up, asset prices fall, and vice versa. I'll explain it in a second. So first and foremost, before we even get into any of that, we have to understand, and sorry to everyone who's watched this 100 times, but it's very, very important that new people understand it. We have to understand how CPI, and now actually how PPI and how CPI impact the market and why it impacts the market. And as well as we have to understand it as a whole, so we can understand how much significance we place on this number coming out, because it's not as significant as you think it is, okay? So I'm gonna go ahead and write PPI in here. So producer price index, and then we have CPI, consumer price index. Okay, so this is a weak lagging leading indicator, and this is an indicator of inflation. So PPI is a weak leading indicator of what CPI is going to be, and obviously CPI is information we're coming out to find today. That's what information we're going to get today, and that is an indicator of inflation. It tells us the inflation rate in our economy in terms of prices, in terms of goods and services, in terms of production, all that kind of cool stuff. Okay, so why is CPI important? CPI is very important, not because it tells us where prices are going to go. That's not why it's important. It's important because it tells us what the Federal Reserve could likely do to interest rates in the future, okay? And that is important because interest rates, as you can see, affects everything else. Now, interest rates, as we'll talk about in a second, is one of the 4 different things, or maybe 5, that can impact systematic risk in a market. And systematic risk in a market is what directly influences asset prices, not CPI. CPI is an indicator of what interest rates could move towards in the future and thus impact systematic risk. So it is a leading indicator. It's a strong leading indicator, CPI. That's all it is. So when we get strong leading indicators announced to the market will react based on what it expects the environment to be like in the future. Okay, we'll talk about that one again. We'll talk about it in a second. So interest rates, very, very important. Now we talked about CPI. CPI tells us what inflation is, and it tells us what interest rates could be. And that assumption of what interest rates could be based on the CPI number is what causes the market to move as it shifts perceived systematic risk. Okay, we'll talk about that in a sec. So interest rates rising, okay, we've seen this, interest rates rising. It increases debt, it increases the cost of debt. So if you have debt, you're repaying more money towards that debt, whether you're a company who has acquired assets on debt, whether you're an individual who has a house loan or short-term loans, you're paying more money towards that. So interest rates have been rising a very long time now. And obviously inflation has been high, and interest rates go up to counteract inflation. They counteract inflation. That's the purpose of interest rates, okay? To keep inflation under control / to bring inflation down. And we've seen inflation dropping now for a while, 2 months. Haven't seen any big slummets or drops in it. We've just seen a steady little fall. And it poses a question, will interest rates continue to rise in terms of basis point hikes, meaning will the basis point hikes get stronger, or when will they start getting weaker? But they're going to continue to rise. There's no doubt, but no one's saying interest rates are going to continue to stop. We'll talk about that one later in a second too. But the question is, will they continue to rise at a fast rate? All right. So with interest on debt rising, household available cash flow decreases as people are spending more money on their debt obligations or saving more money to afford their debt obligations, so they've got more of a buffer. Okay. Cost of goods rise, okay? Retailers sell assets to acquire more cash, liquidate some of their assets to repay their interest on debt, or just keep their debt margins more healthy so they don't feel under financial pressure. The same thing goes for companies, guys. Companies acquire a lot of assets on debt during low interest periods. Why do you think stocks went through the roof? Why do you think stocks and crypto blew up in 2020-21? Because companies were buying up shares, buying up assets. Individuals are jumping in this low debt period, low interest rate period, are jumping in, they're capitalizing. What did that do? Well, it boosted up their future cash flow earnings. And future cash flow earnings is the main predictor of share price valuation. We value shares based on the future cash flow earnings. So it boosted up share values, they were acquiring more shares, everything went to the moon. It had this double effect that boosted everything massively, okay? And then we had more money printing on the side, so everything went up. Now it's the reverse. Companies had a lot of these assets, they made a bit of money, but their debt repayments are now massively increasing and their cash flow values are decreasing as asset prices are falling due to a rising rate. So they sold a lot of their assets, prices dropped, asset prices fell. That's what we're seeing. That's where we are now. So what would happen if interest rates fall? Well, it's the reverse thing, okay? Interest on debt drops, available household cash flow increases, people are more likely to buy assets, cost of goods and services drop, so people have more money to spend on assets. Vice versa for companies. Companies are more likely to invest in assets again. They're more likely to acquire assets. They're more likely to leverage and take debt to acquire assets. It boosts asset prices, okay? In the Flip side as well, if interest rates rise, or should I say drop, the US dollar weakens, okay? So assets rise, which is an inverted correlation between those two. So here's the thing, right? And we'll talk about it in a second. Inflation's been slightly dropping. Interest rates have been still increasing, but they've been increasing by less. This still means interest rates are still increasing. If interest rates increased by 0.75 basis points last quarter and then increased by 0.5 this time, it doesn't mean interest rates have dropped. Interest rates are still rising. That just means it's an additional 0.5 on top. It still is bad for the environment of the macro. But let's go ahead and talk about this. And I'm kind of going on a tangent here, but we need to understand all this to actually understand the full depths of what CPI and how CPI impacts the market. And this is the most important thing. CPI, or the number we're going to get, has a psychological impact on the market. And the reason I say that is because what I said before. CPI is a massive leading indicator of what the Federal Reserve could potentially do to interest rates. And what they could potentially do to interest rates is what impacts the price action, okay? So if there's a perceived systematic risk that is dropped, so therefore if CPI comes in lower than expected, so better than expected, the perceived systematic risk decreases in the market. It decreases because people anticipate the next Federal Reserve rate hike to be weaker than the prior one, as inflation seems to be under control, okay? So therefore, if systematic risk decreases in the market, what do we see? We see this move upwards, and this is systematic risk. This is a risk-free rate, okay? What does that do to asset prices? It shifts them across on the beta, okay? Beta is the risk of the investment. This is the return of the investment. It stays the same, okay? So we see return risk ratios shift. If return risk ratios shift, or risk return ratios shift more favorable, people are more likely to invest, asset prices rise, okay? And that is what we see. So this chart actually shows us that effect. Now, if it comes in worse and the systematic risk increases, this shifts down, the beta shifts down, beta of these assets shift upwards for stocks and crypto, and we see asset prices fall as the risk return ratio gets more negative. Okay guys, one more thing I just forgot to mention about this. We do have the correlation between crypto and stocks. I see a lot of people saying, oh, the stock market opened green, crypto is going to open green. Well, stock market's open red, crypto is going to open red. And although this does make sense, and although it's technically correct, it isn't precise. And it's not as precise as I like to be on this channel. We have to understand that the stock market, it doesn't directly influence crypto market, and vice versa. They are both bound to systematic risk. Meaning, if systematic risk changes, we see both stocks and crypto value change in the same direction. And they're correlated to about a 0.7. If you look at the correlation coefficient, it's about 0.7. So it's not a perfect correlation. And that is why we see slight changes. Maybe one day we'll see stocks rise more, one day we'll see crypto rise more, vice versa. And overall, crypto has a higher ERI. So it has a higher estimated return on investment, but it also has a higher beta. It's got a higher risk. So it's moving more volatile compared to stocks. So you pair that in with the fact that they're correlated to 0.75 or 0.7, sorry. We do see slight variations in the price action in terms of percentage return on investment. But we have to understand that no matter what, they're both correlated to systematic risk. They're both directly connected to what systematic risk does, and it changes the systematic risk, and that directly influences the price action of these assets, and they would generally move in the same direction at the same time. I'm going to go ahead and do an analysis now for the rest of the market. We'll go ahead and do a technical analysis. I hope if you're enjoying the video so far, smash a like. Obviously, it's been a longer video today. I hope it's been beneficial. But I hope you got more of an understanding of what CPI is and what to do. So essentially, just to give you a quick summary, CPI comes in lower, very, very good. Comes in equal to forecasted or higher, very, very bad. We should see a market react poorly. Okay, now we do expect a lot of volatility, guys, particularly leading up to, that 1 hour period before and during and after CPI. There's usually a lot of volatility. Now, the price action will generally spike around, meaning it's not going to go in the direction that it should initially. Usually it fluctuates a lot and then it pumps or dumps and then it goes in the direction it usually does. It's hard to say for sure what's going to happen, just because almost every time I have a CPI, we're seeing a slightly different reaction in the market in terms of how the price action actually moves. We can say for sure it's going to be volatile. So I would say right now, if you don't have stop losses, hit your stop losses, put them on. If you're trading on cross, make sure you definitely have a stop loss. If you're trading isolated, again, make sure your stops are not as tight. And I wouldn't be entering any huge capital positions prior to CPI. You could take some smaller positions, which are very high risk. Keep in mind, very high risk, very high volatility equals very high risk before CPI, but don't go too greedy. You have to remember, these volatile times are not the best times to be trading. They're not the best times to be trading for crypto. There are much better times to be trading in general than these volatile times. For some reason, everyone loves to be drawn in by the excitement, the volatility, the quickness, draws people in, it gets people to throw more money in, and they end up getting wrecked. So be careful, be cautious, and be smart, okay? So TA-wise, let's take a look. We're gonna go do some technical analysis. We'll use indicator. I'm gonna go ahead and just go, actually no, we'll use this chart. This is fine. So, on the daily, prices, let's take a look. Bull market support band, we're under the bull market support band. Again, not something we're looking at too much on daily, but it is nice to see how the momentum's playing out. We can go to the 7-day and really take a look at where we're sitting in terms of the bull market support band. We're still well under the bull market support band on the 7-day. A lot of ground to cover here before we even push above it, which is obviously a bearish thing. Being under a bull market support band is not necessarily a very good thing in terms of price action, but one of the things about the bull market support band, it doesn't actually tell us where the bottom is. So it is a very lagging indicator. Any indicator based on moving averages, I'll go ahead and bring something up like this, which is a combination of different moving averages. Every indicator based on moving averages is going to be incredibly lagging. I can go ahead and show you. If we scroll back to the absolute bottom in December 2018, the moving averages were nowhere near telling us we had any sort of bullish price action going on, yet we bottomed. Okay, you have to understand that technical indicators as a whole, particularly moving averages, are absolutely shit at predicting the bottoms and tops of moves. They're not used for that. Okay, technical indicators are not used to predict reversal points. The only indicator it can do that is probably the RSI, momentum, okay? You can predict shifts in momentum. Technical indicators are used to predict or gauge the trend, the strength of trends. That is what they're used for. If you're using technical indicators, I'm using a MACD, I'm gonna use a MACD cross to predict the bottom, you're gonna be wrong, bro. You might be right once. You might be right a couple times. A broken clock is always right twice a day. But if you do that over a year, you're going to be significantly more wrong than you're going to be right. They're not used for that, so don't use them for that. Understand the limitations of what tools you're using before you use them. You wouldn't use a fork to bang a nail into the wall. You could do it, but you wouldn't use it. You'd use a hammer. Okay, it's much more effective. So use the right tools for the right job, essentially. So let's take a look at some other indicators. And another one I really like to use is Ichimoku Cloud. And obviously I like to use this on a smaller time frame, but we can go ahead and use it on a larger time frame. Let's start on a 3-day chart. I think a 7-day chart for the Ichimoku Cloud is a bit ridiculous. You can see we're still massively underneath the clouds. We haven't really broken over conversion lines or baselines. It's not looking too favorable in the larger time frame. What I would like to point out is we do have what I could see over here is some sort of divergence with our momentum of our lagging span and the price action. As you can see, this is about 26 days lagging. So we have this peak over here, but the price action is actually showing short a sort of increase. And this is actually potentially bullish. This is a good thing to see these divergences in the momentum and price. The only issue is we don't really know the full extent of the impact of this. Obviously, everything in terms of what we're looking for the technical indicators on the Ichimoku Cloud is screaming bearish right now. And again, that doesn't mean the bottom's not in. It just means right now on the larger time frame, the 3-day, it's not showing us any signs of reversal, or it's showing us any signs of entries, because our lagging span's underneath the price is below the conversion line and baseline, and we're underneath the clouds. It couldn't look worse technically. Let's go to a 1-day chart. And you'll see how these indicators shift as we start going to smaller time frames. We're looking for a time frame really that we're over the clouds on. That's what we're kind of looking for. If we can see a time frame that we're over the clouds on, then we can take a look at our conversion lines and baselines. We can look at our market structures and have a look a little bit more and see what's happening. So right over here on the 4-hour, we can see we had a conversion line cross, which was our entry point at 19,000. Now, we know 19,000 actually also provided the basis support for a major horizontal resistance range or support range over here. So we have 2 data points there suggesting a strong support and a potential bottom. We did get rejected from our conversion line, which actually matched up with a downward sloping resistance on this ascending channel, which is a bearish sign. It's not a good looking sign over here. We have some sort of inverted long-legged doji candle forming on the 4-hour chart prior to the current candle, which is a signal of reversal, particularly after periods of multiple successions of green candles in a row. So it's looking pretty bad over here on the short term. It could potentially reject, but again, it's very hard to say exactly what's going to happen from now to the next 12 hours because no matter what the price action does now, guys, CPI is going to throw it out of the water. It doesn't matter if we look incredibly bullish here. CPI comes out bad, we tank. It doesn't matter if we look incredibly bearish here. CPI comes out, we pump. So it doesn't really matter what happens today in terms of price action. It's just more about understanding how CPI is going to change the price action. That is the most important thing of today's video. Take a look at some other indicators. We can go ahead and take a look at the Gaussian channel. I'd like to take a look at the Gaussian channel on the larger time frame. Let's go to the daily. Now this is interesting. It almost looks like we're wanting to push into the Gaussian channel game. Now the Gaussian channel is going to provide a lot of resistance at this 19,200 range, and that is no surprise. That's actually the same price point that we retested on that downward sloping resistance on the small time frame of the descending channel. Now we know that the Gaussian channel is a really good indicator for predicting short-term and macro swings. Generally, when we enter the Gaussian channel, we usually continue about halfway through it, find resistance, or we continue to the top side and break through. So it's very interesting to see what happens over here. We'll have to wait and see, but it is a point of confluence and a point on the chart that we actually are interested in, which is at 19,200 level. I'm going to go ahead and leave it there, guys. I think there's not too much point doing any more analysis. The most important thing, like I said, is that CPI, and we really want to see what happens with CPI. We'll do a video tomorrow and talk about that. So if you want to support the channel, guys, remember the special like button. Go ahead and watch the rest of the stuff. Sign up to Bitget. You'll see a video on Bitget, and we'll see you guys in tomorrow's video. I hope you found today's video beneficial. Cheers. So we're going to quickly have a discussion about Bitget. Now, if you follow the channel, if you're on our Telegram, if you're on our Twitter, if you like the content, enjoy the videos, and just find what we do informative and beneficial, go ahead and support the channel by clicking the sign up link to Bitget and trade where I trade. Now, there's about 10 different good reasons why I'm suggesting Bitget, and obviously I've made the swap from Binance to Bitget close to a year ago now. Last year in September, I decided to go to Bitget and trade on Bitget, and I'm going to go through the reasons why you should actually come over and trade on Bitget too. So first and foremost, guys, if you like spot trading, obviously 0% trading fees on spot. They've got over 260 coins here. Basically every popular coin you can think of is on Bitget. Basically all the coins on Binance you can find on Bitget. Another really good thing is it is global access, meaning there's no global restriction on who can sign up. Doesn't matter what country you're in, where you're from, you can sign up to Bitget. And the reason they can do that is because they do no KYC. KYCing on this exchange is completely optional. If you want to trade on a decentralized exchange where you don't have to sign up, you don't have to have your government information in there, this is where you want to be, completely decentralized. Another really good thing is they obviously have very low trading fees for futures. It's around 0.02%. Now they have around 60 to 70 different trading pairs on futures and are adding more every couple of weeks, so it is steadily growing. They also have a security fund, so if the exchange ever gets hacked or you get hacked, you can actually request a refund or a compensation from the exchange. They have, I think it's like $80 million, or if not more, $800 million or something close to that in the security fund that actually pay out to their users if anything catastrophic happens. So obviously signing up the link, you'll get access to all of that, but there's a few beneficial and extra things you get access to if you sign up the link down below. You'll get access to the reward center. Now on the reward center is about 5 separate tasks, and they're trading tasks. If you complete those tasks, you can make up to $4,163 US just from actually trading. And the second thing is, if you sign up with the partner link down below, you are actually registered underneath my partner account. And what that gives me availability to do is I can actually adjust your fee kickbacks depending on your trading volume. So you actually get paid to trade on Bitget. You'll get kickbacks based on this trading fees you use. For example, on the 3rd of October to the 10th of October, we are doing a running campaign where 10% of the fees you pay on Bitget, you actually receive as compensation as USDT directly to your account. These are some of the things I can do. I can assess your trades, I can monitor your trades if you need advice, I can actually see what is going on, and obviously the fees are very, very small on Bitget. That being said, guys, that is all I want to talk about Bitget. If you want a more in-depth analysis and video about Bitget or how to leverage trade, go to our channel and click the video, how to trade on leverage, and we talk you through Bitget in a little bit more. Thanks, guys. We'll see you later. Okay, guys, I want to take a quick moment to introduce the Become a Trader course at the end of this video. This course was designed by myself and Wolves of Crypto. We put together a whole variety of knowledge to create the most cohesive, understandable, and beneficial trading course there is on the market. If you're interested in learning how to become a trader, if you're interested in learning how to use technical analysis, if you're interested in learning how to apply market analysis to different cryptocurrencies, this is a course for you. We teach you everything from the fundamentals, the basics about what cryptocurrency is, how to trade cryptocurrency, mastering the craft of cryptocurrency, diving into a whole range of technical indicators, market structures, and teaching you how to utilize these when finding trades and applying risk management strategies to become more profitable over time. We even dive into market psychology, human psychology, and provide a variety of different videos and educational content, including courses and quizzes to assist your learning along the way. If this is something you're interested in, guys, go ahead and contact us down below at the cryptoacademycourses@gmail.com. We'll send you an email back with all the course information, the structure, the payment details, and everything else you need to know. That being said, guys, I hope you enjoyed the video today, and we'll catch you in the next one.